Check, please.
Welcome to Everything Money. In this video, we will clearly show you some examples of how to use stock options to make money. To patiently wait as a disciplined investor, you can cash in on this. Paul and Mo will show you how to utilize both. I bring your questions about options to a couple guys that own and operate over $100 million in real estate, multiple businesses, and stocks. This is no joke. They will provide you and I with a mindset about how to do this. So let's get after it. Paul, let's go.
Thanks, Seth. All right, guys, follow us on Instagram. Our Everything Money Investing Instagram account is new. It's growing like crazy. And also follow us personally. Every morning I wake up, check the number of followers I have. By the way, the other day I saw some softball player from college with 15,000 followers who had a check mark, blue check mark. I'm like, bro.
They don't know who you are, Paul.
I'm like, come on, where's my blue check mark? Okay, options. So guys, this is something that is a very useful way to gain income. I use options as a way to generate income on my portfolio, as well as generate income while I wait for stocks to go to the price I want to buy them at. So first, let's figure out how we can make money off of options when you own a stock.
Before we begin, Paul, I consider this a very elite level of trading. I mean,
I don't think it's trading. I just think it's a strategy to, like, trading to me involves like this, like, how do I do things back and forth to make arbitrage and all this stuff? Not for me. For me, so let's get into that. So
I was going to say, because currently options are above my head. And
that's not true. You just haven't spent much time on it.
That's true. Okay, so educate me.
You have a PhD in chemistry. I'm quite sure that's a lot harder than selling options.
Okay, then tell me how.
Although you did go to Ohio State, so it probably was like...
Boom, 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 boom. Go ahead.
All right, so guys, let's say you have Microsoft stock. Now, first off, a regular covered call, you have to have 100 shares of the stock to even trade this. So this is already reserved for... Now, there is what's called the poor man's covered call. I'm not going to get into that today. And there are plenty of videos out there on that. But this is how I generate income. Let's say I own Microsoft. And Microsoft's currently selling for $343. What I do is I go down and I say, okay, I want to make money on Microsoft while I hold it. I sell what's called a covered call, because I own the stock. That's what makes it covered. Call option. Somebody can call the stock away from me, right? They can take it away from me at a future date. So, for example, I'm going to pick January 21st. The third Friday of every month is the busiest day for options.
Didn't know that.
Yeah, so January 21st is the third Friday of January. I'm going to go, and there's a thing called delta. What's delta? Delta in options means the chance of that event occurring, essentially. All right? So I look at Microsoft stock at $343, and I want to find a delta of around 10%. What this means is the chance of the stock hitting that price is 10%. I go over to the left, it's $365. So the markets have basically determined that the chance of Microsoft ending at $365 or higher on January 21st is about 10%. Now, what am I going to do? I'm going to sell somebody the option to buy Microsoft from me at $365. And in exchange, I'm going to get roughly 75 cents.
So you're actually you're selling a contract.
I'm selling an option's a contract. So they're going to give me 75 cents per share. So let me show a blank screen here. I'm going to get, let's say I own one contract of Microsoft, which is 100 shares. I'm getting 75 cents per share, which means I'm getting $75. Not a lot of money. Not a ton of money, right?
Mm-mm.
But here's the key. It's only 23 days from now. So my 100 shares of Microsoft at $345 is $34,500. And it's 23 days from now. So how many times can you do 23 in 365 days? So do 365 divided by 23 equals, call it 20 times? No, that's way off. 10 times 15.
15.8.
16.
So
basically.
16 times.
Mm-hmm.
So if I do this 16 times a year, 16 times 75 is what?
Almost $1,200.
$1,200.
$1,190.
So $1,200. I'm going to make $1,200 a year on my $34,500 investment in Microsoft. What is that as a percentage? 3.5%?
Yes, 3.5.
So I'm going to make 3.5% a year.
Wow.
If I do this over and above and beyond my dividend, above and beyond my capital growth. Now you might sit there and say, that's incredible. What's the catch? Well, here's the way I do it. I don't do it on just Microsoft. I do it on my entire portfolio of stocks. Some are going to hit and some are not going to hit. I never allow the shares to be taken away from me. I'm using it purely to generate income. So I have a list of 30 to 40 stocks. I do it on all of them. And on 3 or 4 of them, I'm going to take a loss because the stock is going to be taken away from me. So instead of letting the stock be taken away from me, the option price would have plummeted and I would have lost money on it. But I made money on 27 to 36 of them. So it's going to cover the 3 to 4 losses along the way. Now, this sounds complicated. Rewatch this video over and over. It takes practice. It takes time doing it. Join our community because we talk about this all the time in our community. I'm using this as a way of generating 3 to 6% extra per year in returns for me. Microsoft, since it's such a big company, has really terrible options. Like Mo, you have Apple, right? Mm-hmm. How bad are the options on Apple?
Yeah, they're pretty bad unless you get pretty aggressive. I mean, you're getting like a 1 to 2% return.
Okay, so let's go back to Microsoft here and talk about getting aggressive. Let's say you own Microsoft at 343 and you want to sell it. You're like, I didn't even want it at 343. But you also are like, I could go either way. I'm selling it. Here's what you do. Sell an option that's really, really high likelihood of hitting, like 45%. And instead of 75 cents, they're going to pay you $5.75.
Now, I hear this is where young and new investors get in trouble is very short-term option contracts like tomorrow.
Yeah, but if you want to sell it at 343, you're happy selling it, go ahead and sell an option at $5.75. If you're going to sell it today anyhow, my argument is if you're like, hey, Microsoft's a great company, I don't mind keeping it if the stock falls, but I don't mind losing it if the stock goes up. Sell a contract right here at 345. The chance of it hitting is 45%, but along the way, you have a 45% chance of keeping $5.75 and keeping the stock. Worst case, they take the stock away from you at 345, which is $1.97 higher. So you still make $1.97 and you collected $5.78 along the way. So you made an extra $7 just by sitting there saying, hey, I want to sell it anyhow.
Per share.
Per share. So on 100 shares, you're going to make an extra $600 by just waiting. Now,
this is extreme patience, Paul.
Well, it's not even extreme patience. To me, it doesn't work on an individual stock. To me, this works on a portfolio of 30 or 40 stocks because I use it personally as a way of generating income. I'm not using it as a way of trading stocks. I use it as a way of generating income. But if I ever have a stock, okay, there's some stocks that I want to buy and hold for a long time. For example, we talked about Visa the other day. One of our videos on Visa. And I was like, damn, I can't wait till Visa's so cheap. And I buy it so cheap and I'm going to hold that thing forever. Microsoft, Google, I want to hold these companies forever. But along the way, I can use money, I can generate income along the way and go, there will be a price of Microsoft. Maybe it's at 343 where I go, I have other opportunities to go buy other stocks at better prices. I'm okay losing it. So I'd sell something at $6. I don't know.
So to recap, the worst case scenario that could ever happen with a covered call is you simply get the 100 shares pulled away from you.
Yes, but for that to happen, the share price starts to go up and you still made money all the way to the strike price. So even at 365, guys, I'm still making every dollar profit up to 365. I'm just not going to get.
You're losing on opportunity costs.
I'm losing the upside of 365. So if it goes to 370, I'm still selling it to somebody for 365, but I still got every dollar between 343 and 365.
Yeah,
so I just made less money and collected income along the way.
Collected premium along the way.
This concept was news to me. You're going to miss out if over the evening it jumps from 362 to 378 because of earnings or something happens. You'll get the shares called away from you and you won't get for the jump. You won't own the shares anymore.
At the time of expiration. At the time of expiration, this confuses a lot of people. So Paul's using the example of January 21st. So let's say on January 14th, Microsoft jumps to 278 per share. 378 per share. It's not being taken away from you.
It can be though.
It can, but on paper, it's not. It's on expiration date. So if the stock price is at 364 on expiration date, even though it went to 378, you still will be okay.
In the last 2 years,
that's an important thing to remember.
In the last 2 years, Mo and I have written tens of millions of dollars worth of options.
I wonder how many.
One time have the shares been taken away from us.
Okay, this is where it gets confusing.
Before expiration.
Because our friend Michael Jordan, who was helping with this.
Not that Michael Jordan, different Michael Jordan.
So you're writing a contract.
Yep.
That has a certain that says these stocks, these shares could be taken away from you, but the contract itself has value. So when you say, I never let this ever hit the strike price, what exactly are you doing? I'm
watching now the one thing you're going to see that's going to scare people. Let's say you sell the option for 365 today, and tomorrow some fluke happens, the stock goes to 370. You're going to end the 70 cents strike price here, you're going to be down tons and tons of money.
So that 70-cent strike price is going to go way up. Because then you have to buy it back for more.
Yes, and you're going to lose a lot of money.
So that 70 cents could go to $1.40. And then
correct. And now you're going to show like I'm down 200%. They're going to be like, how's that possible? Yeah. Well, that's the whole point. You're going to get freaked out, but as long as you hold to expiration, and as long as the stock ends up below that, you'll be fine.
So, Paul, trying not to get over my head a bit.
This is confusing.
Mo, can you use your charts in terms of get a better grasp on where these companies can be going in terms of moving averages and trends?
Yeah, and I actually do. So here's Apple, for example, and this is where a daily chart helps out. So I'm not saying that this is the end-all, be-all, but it can certainly help. So just looking at Apple right now, for example, Apple's at $180 a share. I have options. I have covered calls on this at $200 a share, so up here. But I looked at this saying, okay, on January 21st, the likelihood of this being at $200 a share was about 8% at the time. And this is a very strong resistance point that has been created at about $180 a share. So that, coupled with the percentage delta, I was saying, okay, so it's probably not going to get to that point. That's why I'm going to write those options, hopefully keep the shares, just collect the premium. My goal is only to collect the premium, not lose the shares. You can also go based on moving averages. If, say, you're below a 200-day moving average, you sell your options if you want to keep them right above the 200-day moving average. So there's different ways that you can use charts to do this.
So Mo, when you say I'm only here to get the premium and not let it hit the strike price, what do you do with this contract to
sell it? And you take a big loss. But that's what I was saying.
Sell it to whom?
So sell it to the market. There's always going to be a price for it.
So there was a time, it was about 2 months ago, when I had covered calls on Apple at 170. I was going to lose them. On expiration date, the stock price was at 173. So I was going to lose the shares at 170. I didn't want to do so. So I took a massive loss on those. So I had to buy back the contract for, say it was $10,000. Plus I took a $10,000 loss on top of that.
So what he's saying is he received, let's say, $5,000 in premium, had to buy it back for $15,000.
Exactly.
So when he received 5, had to buy it back for 15, he net lost $10,000.
Yeah. So let's say the premium. So when I wrote those contracts, let's say I got 40 cents per share. At that time on expiration date, let's say it was at 80 cents per share. So I had to give them back my 40 cents, and then I had to give them an extra 40 cents on top of that, which accounted for the loss. But I kept the shares.
So I was saying that the worst case scenario is usually lose the shares, but that's not actually the case.
Well, but here's the deal, though.
Depends on your goal.
Now the stock went up in price to 373, so he made all that money between
170 and 173.
170 and 173. So he made $3 maybe and only lost 80 cents. So you still.
So that's why I don't look at it. That's why I don't look at it as a loss.
You don't want to lose the share. Got it.
Now, the way we're doing it for income, we do this on 30 or 40 stocks at a time. So 25 to 30, let's say you have 40 stocks. 35 of them are going to be fully profitable. You're going to make all your money on that. Then the 5, hopefully, over long periods of time, the 5 that you do take a loss on are going to be more than covered by the 35 that you made money on. So overall, you're still making money overall on let's say the 35 you make $10,000, and the 5 you lost, you lose $4,000. You still made $6,000 overall. So I use the covered call strategy as a way to generate extra income on shares that I currently own for doing nothing but sitting around and being conservative.
Okay, for our beautiful community members of whom we love and adore and are incredibly appreciative, you asked for this many, many times, so here it is, and you're welcome. We will get into puts. We will get into puts right now. But first, Paul, my main question for a normal person in Mo is, how do you keep track of all this stuff? Just in general, like, are we talking a Google spreadsheet?
Yeah, I have an Excel spreadsheet.
I don't even do that. I just do it on my Merrill Lynch account. I just open up my Merrill Lynch account, open the options, and every couple of days, it just sits right there, and I sit there and see. So the other thing that might happen is, if I sell, let's say I sell this option for $343 for 70 cents, like we talked about before, right? The 365 call price at 70 cents. If all of a sudden the stock tomorrow falls to 330, this price of this option might drop to 20 cents. All of a sudden I made 52 cents of the gain really quickly in one day. I'll sell it out, get 52 cents of my gain in one day, and go rewrite another option at a much lower price. I can get instead of waiting the full 23 days to get 70 cents of the gain, I've now gotten 50 cents of it in one day. So these are the things you can do to generate high returns. And instead of it being a 3 or 3.5% return, I've now gotten that return so much quicker. It might end up being a 12 or 13% return. So these are the things, and this is confusing. Trust me, when I first started doing it, I'm like, wait, what? And then all of a sudden you start redoing it, read articles, rewatch these videos, keep looking at this and saying, how do I make money selling? I remember the first time I read about this, it was in a book called The Warren Buffett's Next Door. And it was about 10 or 20 average investors who got really outsized return. And one guy was like, I just sell covered calls and puts on stocks I want, and he said he generates an extra 20% a year on returns on them. He's probably being way more aggressive. I'm writing deltas of 10%. He's probably writing deltas of 0.3 to 0.4%. Because look at the return difference, 70 cents versus $5. It's 7 times the return. And he's much more like, hey, I'll give it I told Mo yesterday, we ran our portfolio on 15% delta versus 30% delta, and the return's over double but for the 30% delta. But Mo was like, yeah, but this. And I'm like, listen, I don't mind trying it out or doing portions. Do a portion of my portfolio on 15 delta, a portion at 30% delta, and keep running them over. My goal is do it over and over and over and over again. Some months I might lose money. Some months I might make, listen, since June of last year, it's been like 98% profit.
Yeah, I've very few times
are they coming, and this is with an up market too.
Yeah, I think I've had two puts or calls executed.
But that's the thing. This is with an up market. Like in covered calls, the market's going up. You're more likely to hit the strike price.
Yeah.
So I'm looking at going, man, this is like, it's almost like, now the catches are, one, I'm disciplined. I will run these on 30 or 40 stocks day in and day out and never even blink an eye. Two, I'm running them at very low deltas, 10 to 15%. Three, I have the shares. Like you got to have the 100 shares of each stock. So if you have a portfolio of 30 stocks and you only have 100 shares on 10 of them, do it on 10, but stick to a systematic pattern of every month you write a new set on a certain delta. You watch them every day, even every day, just glance and say, oh, this one's...
That was my next question, Paul. For our normal working folks...
Takes 5 minutes.
5 minutes?
Just go to your phone going, okay, what I look for is, did any of them gain so much value very quickly that I just get rid of them and rewrite a new one?
And then the other most important part is if you don't want to lose the shares on expiration day, just look at them and say, am I in the water here? Okay, I got to exit these if I want to.
And by the way,
shares.
at 3:30 Eastern time on Friday.
That's it.
Open it up 3:30 Eastern time on Friday and sell all of them. Sell all the ones that are going to be hitting for a loss. And then on Monday, and then that day after close, when the other ones settle, they'll all net together.
Yeah, folks, make sure you write in the comments below if you have questions. And if you're in the community, there are plenty of people who can help you. Paul, let's talk about puts, the exact opposite of covered calls, wouldn't you say?
Yeah, so puts, I use puts as a way of being paid to buy shares at a price that I want. So let's use an example of Intel, because Intel is currently very close to where I want to own it at. Intel's currently at $52. I want to buy Intel at any price below 50. Right? So that's what I determined Intel's, to me, I think the stock is $65 or $70 stock. So but with margin of safety and everything, I want to buy it at 50. So here's what I do. I now go to puts. I'm going to sell somebody the right to force me to buy Intel at $50. So today is December 30th. I'm looking at the January 21st put price, date. And I'm looking at $50. Somebody's going to pay me 47 cents a share to be forced to buy Intel at $50 or less. And the delta here is the chance of it happening. It's at 25%. So I'll do 100 shares, because that's one contract. I'm going to be paid 100 times 47 cents. That's $47. Now, what's my risk? If Intel ends up below $50 on January 22nd, January 21st, I'll be forced to buy it for $50. So let's say hypothetically it goes to $45. I'm forced to buy it at $50. I took a big loss, but I don't consider it a loss. Why? I was going to buy it at $50 anyhow. So the way selling puts works is when you say, I'm going to buy it at this price the second it hits that price. The second it hits that price. So if it hit $50, the second it was going to hit $50, you're buying it anyhow. So if it ends up at 45 on January 21st, you're in the same boat anyhow. It was going to be $45 anyhow. You're still going to pay $50 for it at some point. So the whole key is, do you have the discipline to be able to say, I was going to buy it at $50 anyhow. So if it goes to 45, I was going to lose $5 a share anyhow. So I lost it, except this time I got paid 47 cents per share to wait.
All of this starts with a fundamental analysis and saying, I know where I want this and what I think it's worth.
You have to know. For example, we did the example of Microsoft before. I'm not buying Microsoft at 340. I'm buying Microsoft at 150. So look at the options price for Microsoft at 150 for January 21st.
It's never going to, well, it could, but it's
2 cents.
Highly unlikely to hit that
2
price.
cents. And the delta here is 0.0. It's like literally 7/10 thousandths of a chance of happening. That in the next 23 days, it falls over 50%. So at some point, it's not even worth even writing the option on it. You know what I mean?
Yeah.
It's not even worth that option. It's like, what am I going to write this for? So this is how I use puts. This is how I use options with puts to buy stocks I want, to be paid to buy stocks at prices I want.
And this Street Smart Edge,
this is through Charles Schwab.
Okay, so this is... Okay.
I use mine through Merrill, but I do like their system here. This Street Smart Edge, I put just a few bucks in here just so I can have the system, just because I like the way it's laid out. I don't like Merrill's system very much.
I agree.
No
we were talking prior to this video that Fidelity is a little clunky. So
even Webull has a nice options chain.
Yeah,
Mo uses his Webull account just for the options chain.
Yeah, I don't have any money in Webull, but I use the options chain. It's very nice.
So guys,
wait, I'm sorry. Let me be clear. I can use my Fidelity money through Webull and write options on it?
No. So I'll do is I'll go get the data that Paul has on his screen right now. I'll go and pull that data and just see what the delta is, see what premium I can collect.
So this is just data, and
correct.
And then he goes to,
and then I go to Schwab and I execute.
And then I go to Merrill and just execute the trade.
I see. Okay,
yeah,
great.
This is just for.
So guys, we're using puts and calls to generate extra income on our portfolio. Now, what will that generate for us? I've only been doing it for 18 months, and so far it's been extremely lucrative. And I'm only 10% of my money invested in the market, so my covered calls are very little. I'm going to be able to write covered calls in my full portfolio once I get fully invested. I literally think I'm going to add 3 to 6% a year returns on a worst case to my portfolio. 3 to 6. That means if I match the market and do 10% a year, I'm going to do 13 to 16% a year just by doing options. That's why I always tell everybody, don't follow my investment strategy. Because I have other ways of making money that's going to beat the market in and of itself. I could lose to the market, only make 8% a year and still beat with my options money. That's why it's a lot different. I'm very fortunate to have enough shares, enough money to be able to do that. Not everybody does. But the reason I like this is if you're close to retirement or you want to plan for retirement, it's important to understand this. So that 30 years from now, when you have $5 million saved up or several million saved up, you can do this as a way to generate income and live off that income while you still have money invested in stocks. That's the beauty of it.
The whole time I thought we'd just be sitting around letting it compound, but...
Well, not even letting it compound. You actually got to sit there and hope that it grows, but now you can let it compound while also generating income. Remember, the goal for retirement, there's a goal of pulling out 4% a year. Imagine if you can make 4% a year with dividends and options. That's just very easy. You never have to touch your principal at all. You just live off that money. You have a $5 million portfolio, pull 4% a year. It's $200,000 a year out of your money to live off of. It's incredible.
Yeah, I'm speechless.
My brother and I do. That's what my brother and I talk about with the options money. We kind of look at the options money as our living off of money. And then all the businesses, all the real estate, all of this gets reinvested back in the businesses. That's how we live. That's how we're going to live soon.
Hey guys, Seth here, jumping in real quick. We'll get right back to the video, but I want to let you know you can join our software. You can get access to this financial data and the new Everything Money chat right in your phone. Paul will tell you how to get it right now.
So guys, we created the software because our users wanted to be able to analyze their own stocks without having to wait for us. So we put hundreds of $1,000s, made the software. You get 30 years of financial data. You get access to Seth, Mo, and I, 8-pillar analysis, the stock analyzer tool, the retirement calculator, and you get everything on this main page that is coming soon. This is all included. And if you look right here, these are all the things you get. You get everything on a mobile phone. Everything we're talking about here is ready, available on your mobile app. One app for everything. But most importantly, guys, you get our Discord, our community of, now it's off of Discord. It's right in our app. You get a community of over 6,000 people you can talk to every single day about your investment ideas. If you're like them, you felt alone having these ideas about investing that weren't reciprocated by others, but now you found the community here. And this is all available for only $1 per day. Less than a cup of coffee. If this can make you 1 or 2% or save you 1 or 2% of losses every year, it will lead to hundreds of thousands, if not millions. $1 per day, 2 ways to sign up. Everythingmoney.com or Patreon. The benefit of everythingmoney.com is we're not large enough yet to charge sales tax, so you won't be charged sales tax quite yet. And look at this, guys. You get all of this. Our competitors are a lot more money, and don't provide as much. $1 per day. Go sign up now.
That's our take. Options, covered calls and puts. Comment below. Join the software. Chat with people. They can help you. And we will update you. Paul, I want this to be part of my 2022 goals to really get a grasp on this. That and trading. I've cleared my other businesses and my schedules to give me time to do this.
Great.
Yeah. So
let's trade, baby. Me, you, and Mo. We're going to trade. We'll get him started on TradingView, and we'll give him 3 stocks to look at. 4 stocks to look at. You 4 and me 4.
Yeah, let's do it.
All right.
Great plan. All right. Final thumbs up. Join the community. You will love it. See you soon.